All right, Jules, thanks so much, everybody. Well, to take us through the close on this Thursday, we've got an investor sitting right across from me. We're talking about Scott Black, president of Delphi Management, with about $1 billion in assets. As you folks know, if you're a regular watcher, he's a value manager and disciple of Warren Buffett. Also with us from the CME Group in Chicago, Joe Cusick of OptionsXpress. He actively trades those S&P futures contracts. Folks, good to have you here with us. Scott, I want to start with you. And I know you're a stock picker, you look for value plays, but I got to ask you a little bit about kind of the momentum we're seeing in the market today. Nice little rally. GM Ireland, what do you make of it?
Yeah, full of fury, signifying nothing. 2 days ago, China comes out with 4.4% inflation. The growth rate might be cut from 9.6 to 9.4. We should have that problem here, and the market tanks. Unfortunately, macroeconomic events seem to dominate the fundamentals and corporate earnings on a day-to-day basis. There's a little bit of a casino mentality.
So be careful. Don't read too much into this rally.
I agree.
Joe Cusick, I want to bring you into this. Do you agree with Scott? Be very careful. Don't read too much into any kind of big moves here.
Oh, yeah, I totally agree with Scott. It's been fickle at best, the way the market's been reacting, these headlines. The dollar is dominating this. We can look at that cycle, but bottom line is that for those that are looking to jump into this market at this stage, be very careful, be very precise. I'd almost size down. There's a lot of emotion in these markets right now.
Well, and there's also a lot of emotion over General Motors. I mean, Scott, let's throw that on top of it. We've been talking about it for weeks here. I mean, but good to see this company IPO and come out so strongly.
Yeah, except that the United States government left about 2.5, 3 points on the table, so it's not good for the taxpayers. But all things being equal, that is a good sign. All
right, everybody. Julie and Dom just making the point about kind of the difference that we see, the healthy corporate balance sheets, healthy corporate America versus what we're seeing with consumers who are still having a tough time. Does that at all impact kind of your investment decisions?
For the most part, it does, because the fact is, until we start putting people back to work in this country, the real GDP growth is going to be very stagnant. Obviously, it does. You know, the kinds of stocks I'm going to recommend to you today are on the industrial sector. Yes, we've made lots of money in things like Ross Stores and TJ Maxx, but they're on their highs now. They were just well run. They had good comp stores throughout the recession.
Does that mean you've sold them?
No, we haven't, because they're not quite at the price, PE parameter to sell them. But it's true. You can look at things like factory orders and durables, and most of these numbers are up 10 and 12% year over year. Then you look at things like personal consumption, income, and those are 2.7 and 3.5, and you see a big schism between the numbers on the industrial sector versus the consumer sector.
Talk to me about the industrial plays that you like. One of them is Boise Cascade. This stock has had a great run. It's up about 41% this year.
It's called Boise Corp. The symbol's BZ. It's a $7 stock. The book is about $8.12, selling at 87 cents on the book, and they're going to do $1.10. It's a 6.5 PE. The management's been in. They're generating lots of free cash, and they have the wind behind them, especially in linerboard and container. They have a small business still in writing papers. That's a cash cow, only 2 to 4% grower. But the linerboard and containerboard is a proxy for industrial America, and that's booming at double digits.
It's a small market cap, and I always like to point this out. It's about $605 million. Does that mean we should expect a lot of volatility with this name, or what?
Not really, as long as they continue to deliver earnings and you have price protection. You know, the old Benjamin Graham margin of safety. When you're buying below tangible book, you don't have a lot of risk.
All right, another company that you like actually has overseas exposure. And what's interesting, I was just watching Gap with their earnings coming out, and they're talking about opening their first outlet in South America, in Chile. You like overseas exposure, though, to some of these companies?
Well, we have Vale, which is based basically in Brazil, but only 15% of the business is in Brazil, close to 40% of the business is in China, predominantly an iron ore company. They have the highest grade ore, both iron ore and pellets, along with Broken Hill and Rio Tinto. They basically dominate the space.
Right.
And I know where everybody's worried that China's going to slow to 9.4% growth next year, but the rising tide carries all the ships out to sea. They're probably going to do over $4.20 next year.
Nice,
it's a 7.6 multiple. I mean, the company made $6 billion net after tax in the latest quarter. It's just unbelievable.
Hey, Joe Cusick, I want to bring you back into this. You know, Scott always finds, interesting companies that are making money, even if it's a difficult environment. I mean, we have to kind of remember that when we look at the trade, whether we see a significant move overall in the market up or down. I mean, there are some winners, some losers here, even no matter what the overall trend is.
Oh yeah, no, there's no doubt about it. And you know, Scott brought up, I mean, strong balance sheets. You look at where their opportunities are. The Brazilian company, actually, it's funny that you mentioned that, Scott. That's one that's come up on the radar screen, and we liked it because of the fact that it had so much more exposure outside of Brazil, and those are kind of the things that we're looking at. But you know, traders down here right now, this is a busy week for us because it's expiration, and we're really seeing some battle lines being drawn, and we're also seeing a lot of bullishness on the retail side that, from a contrarian perspective, is highlighting that, you know, we have to be very leery though before we start jumping in, even on these pullbacks in some of these stocks that we continually hear a lot of pundits talking about that they're rolling money into. We have to be very careful because we're walking into some volatile territory right now.
Well, and that's a good point, Scott. You know, I think about, I was talking to a lot of CFOs today, and they talk about still so many concerns out there, and they're worried about what's going to come down from Washington in terms of tax policy, regulatory policy. I mean, does that make it tougher, too, for you to find kind of investment opportunities at this point?
No, because we stick to our discipline of doing the bargain basement. But when you look at things like financial service, you know, they're basically, the larger banks are still way under reserved against non-performing assets. Mm-hmm. So it's not a question if they're selling at a 7 or 8 P. If you mark the portfolios to market with the receivables, the mortgages, the credit cards, I mean, there's not a lot of earning power. You have to be very careful in this environment.
Well, in terms of those financials, Scott, in terms of the foreclosure mess, again, that we're seeing with the robo-signing and so on and so forth, do you think that there's going to be kind of potentially another significant leg down for those financial names?
I don't think so. I think it's still priced into the bigger companies, but 25% of all mortgages in the United States now are underwater, which doesn't bode well for a strong recovery.
Right, makes it very tough. We're going to have to leave it there. Scott, thank you so much. We really appreciate it.
Thank you for having me.
Good to catch up with you right here. Scott Black and Joe Cusick out there in Chicago.